Hello and welcome to T&M TV News. I'm John Cumming, editor of the Northern Miner. We continue with our coverage from the PDAC convention in Toronto, where mining markets editor Alicia Hyatt caught up with John Kaiser, editor of the newsletter Kaiser Research Online. Kaiser explains why he believes gold and silver equities might rally this year and gives his take on the current state of the broad markets as well as rare earths, tungsten, and graphite.
The volatility that we experienced in the second half of last year drove a lot of investors out of the market. Do you have a sense that they're starting to come back in yet?
I think it will be a while for investors to come back. It's really been hammered home that there's a lot of stuff wrong with the economy, the financial system, and so on, and what's needed to fix it. Some of the recipes that have been proposed, actually austerity and so on, are recipes for things getting a lot worse in terms of economic growth and so on. So nobody is sure that it's time yet to come in. This is a classic wall of worry, which of course makes it a very interesting time to be paying attention to this and doing your own crystal ball gazing about how the future will unfold.
So you're very big on gold and silver junior miners. Can you walk us through the investment rationale there?
We're seeing about a 60 to 70% real increase in the price of gold, and that is very significant for the juniors and the seniors in terms of cash flow potential and actual cash flow. Now, companies are trading at fairly low cash flow multiples because the assumption is gold and silver are in bubbles, and in the next year or so we'll go back to 3-year trailing averages, and that will wipe out the cash flow. So the market is still biased towards the negative scenario. I think the move in gold reflects actually optimism about the global economy, but awareness that this means that the United States, as the biggest economy, is in a long-term trend of relative decline, which will compromise its ability to keep the global peace through its enormous share of the global military budget that it carries, and for which the revenue base is not in place to sustain. So there is structural anxiety in the system that just prompts wealth to park some of itself in gold and silver as a long-term hedge about the uncertainty that comes when the balance of power changes both militarily and economically. So I think gold prices in the $1,500 to $2,000 range are a new reality, and what's we're waiting for is an inflection out there where people stop worrying about gold going back to $1,000 and silver back to $15. Unfortunately, I think the trigger will probably be something in the Middle East with Iran at the center, and I think we'll see some sort of spike in gold above $2,000, driven not by financial anxiety such as currency debasement or hyperinflation, anything like that, but geopolitical stress, which will pass. And then when gold comes back to these levels, then there will set in an acceptance. This is the new reality, and that will actually be the trigger for the bull market in the equities, the juniors and the seniors. And that's in fact what did happen in 1980. It actually was a lagged, the move in the juniors lagged the gold price spike.
And you see that happening this year?
Unfortunately, yes.
You were one of the first to start talking about the rare earth sector. That's gone out of the spotlight recently, but you say you see it coming back this year. Why do you see that?
Rare earth sector got a big boost last year when not just FOB spot prices went way up, but Chinese domestic prices went way up. However, this was a classic sort of supply squeeze, where we had hoarding of the material in anticipation of higher prices, and we saw a tenfold spike in prices that brought prices to a level that is unsustainable in terms of end users wanting to use these materials. Very similar to uranium going to $140 and plunging back to about $50, $60. We are now in the plunge phase for the rare earth oxide prices, and we have not yet seen the bottom. Meanwhile, the equities are going to be hurt by the optics of this deflating bubble in the commodities themselves. I think this is a year where the companies that have advanced projects, that have been successful in going to the next level, they will get the attention. we will likely see some M&A activity come into the sector, or at the very least, the end users now are paying very close attention. They're talking to the advanced companies, and solid deals, perhaps something like what we've seen with Toyota and Matamak. If Toyota comes through and puts up the money and says, yes, we're going to take 49% of this project. If Cores comes along that says, yes, Frontier, we are going to take a piece of this Sandkopsdrift deposit in South Africa. This is the year where these things have to happen. If they don't happen, the rare earth sector, the junior part of it, is in danger of fizzling away and not getting the capital needed to really advance their projects. And then we get back to the original problem that China controls all the supply. And I think about July is when we'll probably see the pivot point, because that's when we'll see what the true nature of the latest Chinese export quota really is all about. Right now they've got a dynamic system in place where they can adjust how much is available simply by determining which processors and producers are environmentally sound and move them from provisional to confirmed. Right now, less than half of the quota is actually confirmed. It's all on a tentative basis. And if there are problems such in the Middle East, and there's geopolitical tensions over the supply of oil, of which China needs a lot, and the United States has made it clear that they are shifting their military focus from the Middle East to China itself in a kind of a containment strategy, we could see things get very touchy with the rare earths again, and that would make it a media topic again in the second half of this year.
There's another specialty material that's been getting a lot of attention, graphite. But are there any other specialty materials or metals that you see as more important?
Graphite benefits from graphene and all these sort of, this is a new material type of hype that we get. But a very old-fashioned metal that's going to become more important in the next while is tungsten, which, like graphite and rare earths, its supply is dominated by China. Tungsten is critical in tools, in particular in the oil and gas drilling industry. And right now, one of the big stories being circulated in the United States is the United States, if we do end up with high permanent oil prices, the shale oil and shale gas will be eventually allow America to be self-sufficient in its oil production. And that would be a major change from what we have had for the last 20, 30 years. These drill bits, they require tungsten in them. Also, if we see military tensions escalate, problems in the Middle East and all that, tungsten is a key ingredient in armaments and so on. So, of course, all of it comes from China, and China has put tungsten on its special list of materials for which it controls the supply. And we saw Warren Buffett, through a company that he has a stake in, do a deal with a Korean junior to ensure that it has 90% of its of the supply going through to it in an offtake agreement. So that's sort of an overlooked sector, which I think will get attention.
One note on rare earths. Since the PDAC, rare earths have been in the news again as the EU, US, and Japan filed a complaint with the WTO about China's rare earth export policies. And for more on why John Kaiser believes gold and silver equities are going to be big winners this year, look for his article, available for free, at miningmarkets.ca in the Investors Corner box. Thanks for watching, and join us next time for an interview with Gowling's mining lawyer David McIntyre about Chinese investment in Canada's mining sector.